Well, it's a pleasure to be here today. I am not a professional speaker. I'm not even really a farmer. I didn't grow up on a farm, and I didn't know anything about pigs when I started raising pigs or took over the managing partner job. So I do think, and this is just my opinion, and I think if you ask Dr. Dreetz and Dr. Goodband and Jim Nelson, and when we first started our research farm and our relationship with them, I think not having bias about how pigs should be raised, and maybe an education like some of the kids sitting over here, some of which are friends of mine, one of which is from Pipestone, so it's good to see him today. I think it's helped our business, and I don't know if this is too bold of a statement, Steve and you guys, but we really, at the same time, I think my mindset was to push those guys too. I mean, we did a lot of trials that I'm sure Steve and Bob and Jim and everybody thought, this is just crazy. This is not going to work, especially things, I think, around distillers and especially early on, synthetic amino acids and different things. But it's really helped our business on diet formulation. These guys have done a hell of a job for us over the years, and the relationship's been great. And I just want to thank you guys for inviting me here today and taking the time to listen to me. I won't sound near as eloquent as your next speaker, Joe, and hopefully he's got good information on the price. He's shaking his head no. So, but I am thankful to be here today. The last time I went through some of my presentations that I've given to different organizations, and the last time I was here to do this exact same thing was in 2009. So I looked at how our approach to risk management, and some of this stuff, there's people in this room that are doing this every day. Art's doing it. There's plenty of people that either hired CIH or Joe or Pat Von Tersch, the guy that we work with in Laverne, Minnesota. There's plenty of guys out there. So this is not the subject of risk management and managing your margin, or attempting to manage your margin, is not new. But we were one of the first ones that started this, making this model. And I don't think that's too bold of a statement either, Joe, because you and I met a long time ago, and I think that's really helped our business, being an early adopter of that. So without rattling on about that, don't tell me this thing's, thank God. So here's a little bit about our company. Joel said some of this, we're 16,000 sow, farrow to finish. When I took over in 2000, it was late 2001 technically, we only had 6,000 sows then. So we've grown just like a lot of the rest of you in this room. We haven't stayed stagnant. The feed mill at the time was producing, about 40,000 tons a year. Now we're producing 160,000 out of the same feed mill, and a lot of the students got to see it. It's an older facility, but it's functional, and we've attempted to keep all the current software and most recent stuff in there. We also own and operate a grain elevator in town, which is separate from our feed mill, and the advantage of that is just to be able to source our own grain. Going through 300,000 bushels of corn a month, even in southwest Minnesota, our feed mill only had about 250,000 capacity, so we were always getting just hammered by basis because we were going through the corn so fast so we had to do something about that. A few of the highlights on our research, which I really enjoy. I don't get involved with it as much anymore, just because we have grown and my responsibilities have changed. But it is still, it's made our business better. There's a lot of things that make your business better, but the research and knowing I'm going to pump these nutrients into these pigs, these genetics, and this is what the outcome is going to be, and there's nothing more valuable than understanding that, and I'll go to my grave saying that. But we operate a 4,800 head grow finish research facility in conjunction with K-State, and it's fairly pretty much exclusive to K-State. We've got some other facilities now that, so we try not to, Steve and I had a couple interesting conversations about that one time, but we try not to clutter up the research farm that we built for them with any other nutritional companies. We do operate a 2,400 head research sow farm as well, another 4,800 head research nursery, and another 2,400 head grow finish research facility with another nutrition company. If you guys have any questions too, just feel free to say. I know Joel probably wants them to wait till the end, but if you have something. So the topic I was asked to speak about was just our approach to managing the risk of our business. Anybody who owns a pig, is involved in allied industry, anything, feed mills, all the different sectors that are here today understand that there's a lot of risk in raising these animals, both disease, price, coronavirus. Who would have thought that would have had an impact on the market last week? All kinds of different things out of our control. Donald J. Trump. There's all kinds of things that have impacted our business. So the overriding concept I wanted to talk about was, and we started this in 2001, and we really tried to develop a sustainable risk management strategy that was nimble. So when I say nimble, like nimble enough that we were not so set in. First of all, I've got all A's in math. I always joke about that with my employees, and that when they're challenging me on things, I say I got A's in math, but it does help when it comes to stuff like this. So when I say nimble, I'm nimble enough that we are willing to change it. We don't know everything. We're pretty humble people, and I'll be the first to admit we don't know everything. I'm not really sure some days what we know and what we don't know. Anyway, we started defining this plan in 2002. Like I said, an early adopter. We started by identifying the risks, which were pretty simple back then. It was really just hog price, and there's another slide that shows that, because back then corn, Southwest Minnesota, if you paid $2 for corn, you were paying way too much, and especially back then, or $180 for soybean meal, and distillers weren't even on the radar screen back then. So once we identified the risk, we said, well, given those risks, what's our expectation for return? We attempted to quantify that. I'm also not an economist, and we didn't hire an economist to do this, but between our shareholders, we came up with what we felt at the time was an acceptable rate of return. What was our tolerance for risk? Some days, last week, there's a good thing. There's a reason God invented Miller Lite, and last week was reasons why. But there's weeks like that where it'll make you wonder sometimes when hogs drop that much in 1 week. Then the other thing is, do we have sufficient capital available? So we needed a good lender. We work with AgStar Compeer Financial now up there in Minnesota to fund our margin calls and then just the ongoing operations of our business. And I know some of this initial stuff is common knowledge to everybody, but it's just the process we went through, and that's what I was asked to speak about. And if you believe in managing the margin, you're not necessarily trying to predict the market. If you've said, I want to make $20 a pig on average for an entire year, or 25, or 30, or 11, or whatever the number is based on your cost structure and your location, then there's no sense trying to predict the market. Joe's job, as I understand it, and as I've heard him speak, and he's very good at it, is to help give the framework for what your expectation for price might be, but not necessarily telling you this is what the price is going to be, because there's no guarantee on that. And from that, then we set targets for each individual trading month so that we could have some framework for a disciplined trading approach. Our hedging strategy, we have a stated company hedging policy that was approved by our board of directors. We actually are one of the few companies of our size anyway, when I talk to colleagues in the business, that we actually have a board, none of which are family members, none of which work there. I'm the chairman, so I'm the only one that works there. But the other 4 are two are shareholders and 2 are not. One used to run a big company in Kansas City, I won't say which one. One runs a big company in Mason City. One is a attorney in the cities, and one's a retired senior partner from PricewaterhouseCoopers. So we do have a fairly wide breadth of expertise on our board, but we do have a stated company hedging policy. And again, we've set a goal for an acceptable rate of return on investment commensurate with the risk based on historical returns given our overall cost structure. So like I said, Art's cost structure is going to be different than mine. It just is because of where he's located. This is probably the hardest thing to do. I change this in this slide, is to execute the plan. Emotion comes into last April, March and April, early May. We should have been hedging all our hogs for as long as God would have let us do it. And I don't think anybody hedged enough hogs back then when ASF and the traders really wanted to take hogs higher. And that turned out to be a mistake. But it was a lack of execution at that time that caused that. And trust me, I got a majority shareholder that reminds me of that all the time. We don't look back at and second guess what we've done, because you're just going to kill yourself doing that like anything else. We learn from what was done to enhance the plan, change the plan, lower the target, raise the target, different things. But we don't look back and say we should have never done that, because I already told you that March and April of last year, everybody in this room who watched hog prices knows that every hog you have, like I said, through August of 2020 should have been sold. And then no emotion. It's an unemotional. There's no emotion tied with this. You start worrying about, am I going to do the right thing? Should I call my pastor and ask him, should I trade my hogs, or what? Anything. You guys get the point. There's you either are going to have a plan and execute it, or you're really going to go nowhere, in my opinion. So available tools, a lot of these are obvious, but I just want to point them out and just then identify which ones of them we predominantly use. There's obviously options, your puts, calls, collar strategies, etc. There's straight futures markets, short on the hogs, long on the corn and the soybean meal. Our philosophy, though, is to predominantly just use futures to manage and set a targeted margin. We've never really gotten comfortable just using options. There are times where we probably should have and would have made more money, but we made our target. We have very stable earnings, which is important for lender relations. Interest rates are a lot lower when you have stable earnings, I can tell you that. So we predominantly just use the futures only, no options. We do, this is a little bit different than maybe, a CIH model, where they might not to pick on them, but it's the first one that comes to mind. We have a judicious lifting of our short hog positions. And what I mean by that, so we've never lifted a hog position, a short hog position, unless we were in that delivery period. So we're not in and out of the market. There are a lot of people that are. I know a lot of people that are long hogs who own hogs. Well, now they're double long hogs. So that's not a hedging program. But we've never lifted hog positions. And this might, again, go against Joe's better judgment. We just never have done that because we've managed our target and we're going to stick with that. However, December of 19 is a good example. We had every single one of our hogs sold on the futures market, and that thing just cratered. Well, there are certain advisors that would say, well, if you delivered 30 loads of pigs this week, you better lift 30 loads of contracts or now you're long hogs. Well, when you're watching the market go down every morning, I mean, I decided it was better to be smart than stupid. If you're watching that market go down, you might as well just keep them short positions on. And we rode every single one of those short futures positions down to expiration. Well, the difference, when you figure it out, just for our company was either $1.1 million you made hedging, or it turned out to be 3.3. That was the difference. That's how fast that market went down for the number of positions that we had on. So when I say judicious lifting of short positions, that's what I mean. There are some things over the 20 years of doing this that I've learned that I can get away with. Same thing's true right now, February, right, Joe? I mean, that thing's going in the tank too. We got good advisors. We utilize two, but each one has a different purpose. And somebody might ask a question, well, what are the two purposes? One is just to help us do our trading, and we clear through them, and to advise us on hedging. And the other is just for information, a guy named Brett Stewart, who's with Global Agri-Trends out of Denver, Colorado. So managing the margins, our plan is just to manage a targeted crush margin, and I won't say exactly what our target is necessarily, because it's changing over time, and needs to be changed over time, and it would probably be a little higher than some people might expect. We developed a crush margin model, and it's evolved over time. I got 3 slides coming up that show how simple it was in 2002. January 3rd of 2002 is the date on it. And there's one from 2009, and now there's one from last Friday, and how drastically different they are in the elements that are in the tool that we use, that we developed ourselves. Okay, so how do we go about doing this? We start with our known all-in costs per head other than corn, soybean, meal, and distillers. So in other words, if all of your costs, payroll, buildings, or depreciation, fuel, snow removal in Minnesota, which is a big number it seems like, propane, all those things, and fix that to including the wean pig costs, so operating a sow farm, into an all-in cost, and then we wrap the price we let the cornmeal and distillers prices flow with the market then, and then with the hog price to determine what our margin is. Yeah, month by month, we're looking at the margins. Some months it's you can make your targets, and other months you can't. We trade those that we can, and we don't trade a lot of times those that we can't. There has been one change, which I will bring up in a slide, where we've had to change the way we look at things over time, because like I alluded to a little earlier, corn used to be $2, and you could count on that like Sunday's Sunday, and Monday's Monday, and Tuesday's Tuesday, and corn and meal was $180. We're looking well into the future. We've had times where we've had 18 months of hogs sold because there was the margin was there, and we wish we would have done that this time. I don't know why it didn't. 2009 was one year where we had everything hedged before the financial crisis, so you probably can imagine how that turned out. That worked out really well. And we're not afraid to lock in margin in deferred months. It's just, if we know we have margin, we're not afraid to lock that in. Here's just one graph from NutriQuest, and Steve Weiss, the president of NutriQuest, he puts this out every Friday, and I'm not sure how many people in this room get his emails or not, but what this graph represents, and oh shoot. This line right here represents 0, if you can't see it out there. So what this graph that Steve does, this is every data point on this graph is a 12-month looking forward average margin on that particular day. So it's today, so then it's always done on Fridays. So it's last Friday's, you can see the big drop last week. That's last Friday's forward looking next 12 months. And the point of this graph is if you had a plan other than in 2012, and this starts, I know you probably can't read it out there, but these slides are going to be available, I think, right? So it starts in the fourth quarter of 2008, and you can see how consistently the 12-month forward margin, now this would depend on your target. If your target was $40, the year you got PEDs, the only year you made $40, if that was your goal. But if it was 15, look at all the time that you could have easily made $15 a pig, or even 20 on a 12-month rolling average. And this graph does a good job of showing that. There was, obviously when corn, the drought year there in 2012, things got pretty tough. And then in late in 18, things didn't look very well either. But there's very few periods in there. 09 was the year, I think that was a chicken when the bird flu, right, Joe? Or it wasn't the cattle deal, it was bird flu. Yeah. So, yeah, swine flu. So this graph does a good job of, I think, showing that a disciplined approach will and can allow you to lock in a fairly decent margin for a long period of time, and there's just a lot less concern and stress. It's gotten a little tougher, and I'll talk about that here in a minute, the last little while. But so this is how simple our hog margin worksheet was on, I guess it was January 13th, not the 3rd, sorry. But you can see how simple our sheet was back then. I literally have a copy in my office of the first one we ever did, and it was actually in handwriting. It wasn't even in Excel or anything. And in here, there's a lot of elements that are the same in here as the forward years. So here's this all other expenses minus corn and meal. We didn't even include distillers back then because there wasn't much ethanol around in 2003, and we were probably just dabbling around with them back then in the research farm. Probably just getting started, if that. But anyhow, we didn't include distillers, and so we had our $2 corn, there it is. And then you look at here, $2 every month, and $180 meal, $180 every month. And our cost of production, we just fixed it then for the year. This is per hundredweight. That left us with this margin based on this price and these costs, and with the $82, $5.39. At that time, this was less than our target, so we probably weren't doing much at that time. But then you had your annual average right here. So fairly simple sheet, and it was easy to understand, and everything made sense when corn was $2 and meal was $180. It was not that complicated to hedge hogs. Well, then in 08, I'll start late 07, 08, 09 when the financial crisis hit, and corn went to, the highest I paid in Pipestone was $7.43, and I know there's people paid more than that. We decided that we couldn't do things, we certainly couldn't count on corn to be $2 anymore, for one thing, at least not for a period of time there, and actually it's never gone back to, I actually got a bid sheet that I saved from 2004, corn price in Pipestone, Minnesota was $1.26, and I still have it, I was going to frame it, I think. But the corn got quite a bit more expensive, so we added some elements in here, because what we started to do, and this wouldn't have followed with our original written plan, but I think it was a necessary step. We started getting long corn without being short hogs, because there started to be some trends in the corn price, and corn ownership at that time, 346 in July of '09 was good ownership that we had. This would have been our actual ownership at that time. I'm not sure what the futures price would have been for sure, but that would have been our ownership of corn then, and same with soybean meal. And so you can see there's more elements to this sheet here than there was on the original one. And of course our other costs, just like everyone else's, have gone up. Fuel got more expensive, labor's gotten a hell of a lot more expensive, trucking's gotten more expensive. There isn't anything that hasn't gotten more expensive. Buildings, everything. Here's our most recent sheet. I apologize for blacking this stuff out, but I didn't want to make a generic one, so call me lazy. Everywhere underneath there in the black is actually what we got done for this year, so I blocked it all out because I think my shareholders might kill me, especially knowing the the slides, and although I see one number in there that's, well, anyway. So our all other costs have gone up again, so another $7. And but one thing that we did then, we got to be a very aggressive user between, say, '09 and now for sure, but '09 really probably through 14, maybe 12. Really aggressive user of distillers and synthetic amino acids. But again, a lot of that stuff was because we felt comfortable about what we had done at the research farm. And there were some negatives to it, but there were also some positives. And the price of distillers in our area was, dirt cheap. There's so many ethanol plants within 45 miles of Pipestone that the distillers were, we were buying distillers back for $60 a ton, where now they're $136, I think we're paying right now for distillers up there. So we added an element in here of distillers. Oh, one thing I should do is I should back up. I wanted to point this out. So you look at in '02, we were using on average, and this would have included the South farm, so the South and gilt feed would have been in there, but per finished animal, we would have used 158 pounds of soybean meal and 8.2 bushels of corn per finished animal. And you can see how those numbers changed as we started using either alternative ingredients like distillers, bakery meal. The corn dropped to 7.5, meal down to 130 pounds per animal. Then you look fast forward to now, we're using just 42 pounds of soybean meal per finished animal, and that again includes the sow farm. Just 7.65 bushels of corn, but 242.5 pounds, so more than 1/10 of a ton per animal, and that goes across everything. We got it in sow diets, gilt diets, finishing diets, late nursery diets. And so you can see how our sheet has changed. We added the number of pigs to be sold, which determined our number of contracts. This is where this column here would be our average short, so how many contracts we got and what number we're short at. Somebody who's really good at math could actually back figure this and figure out how short we are, because these are the prices, our net price with Friday's market price here. Then we broke the corn and corn equivalent, so we've hedged the corn, so these two numbers we've added together, distillers and corn, and got a corn and corn equivalents and or bakery meal. We would consider corn because it's based off the price of corn. You got your corn price here, your futures price, our assumed basis up there, your net price. Soybean meal, we've got that all locked in for the entire year already. For this basis got extremely wide up there, 45 under on the meal, so we just took advantage of that quite a while ago actually. So we got our meal bought a little bit above the market, but most of these months we were able to manage our targeted margin, which would be right in that dark cell. So that's our approach, and that's how it's evolved, and that's how much it's out of necessity it's had to change, because nothing stays the same. That's obvious, but nothing in the pig business has really stayed the same at all. So I think that's my last slide, Joel. But I thought it would leave some time for some questions if you had some. Or
yeah. Any questions for Bob? We got a few minutes for those. Mike. So I'm going to repeat the question. So question was, there's a hedging policy for the company. What does that all entail?
The hedging policy, it's a 2-page document, and it will outline what I am allowed to do and what I'm not allowed to do. So 3-way trades, which I know a lot of people use 3-way trades, I am allowed to do them, but only in certain circumstances. Technically, but they got a lot of trust in me after 20 years now, I'm supposed to be using options to lock in a break even. Well, by the time you take the price of the options, if you wanted to do that for hogs for next year to lock in a break even, first of all, I don't even know if some months you can lock in a break even, and by the time you factor in the cost of the options, you won't spend all the money, I get that, because there'll be, at some point you'll remove the option and put a short futures on. But I don't follow that part of the plan, and I've kind of talked them down from the ledge. But we do have also a committee, a 4-person committee. I don't use them as much as I really should. We do have a call now once a month on the second Tuesday of the month, just to keep everybody grounded in what's going on and updated so everybody knows, some of which are board members, and then of course Pat Von Tersch is on that call as well, our hedging advisor. It talks about the lender in there, and what the requirements from the lender, what they wanted to see in our hedging policy, what they would have liked. So it's a fairly comprehensive document that really covers all elements of trading, and really the very specific things like thou shalt never get long hogs, period. So don't get yourself double long hogs since you already own the pigs. So there are some hard and fast rules in there, and it's not quite like the 10 Commandments, but there are some rules in there, so it'd be things like that, Mike.
What other questions you have for Bob? Yeah, I'll have one. Bob, how do you decide when enough is enough, right? So, we can always, you say you can't look back in time, but through your process, how do you just decide, looking out today as example with some of the changes that have recently happened, what's enough? Is there any typical guidelines you use for trying to set those, your marketing strategy based on your risk management?
Yeah, well, I'll give you a joking answer first. Last Friday when the market was down as much as it was, I was about ready to say enough is enough, and you guys know what I mean. Enough's enough. I'm done. I'm not doing this no more. Last week was but there are, we try to stick to just our expectation for percent return on our capital. And we try, but that's getting tougher and tougher and tougher to do. And so we've had to revise our expectation for return down. But then from there, just in the seasonality of the trading of different months, there may be times where we say we can't wait any longer to get some hogs hedged. We might be wrong, and we might not be achieving the target, but we better get these hogs hedged because seasonally they're going to go down. Outside of some Black Swan event like coronavirus, ASF in China, which really hasn't done anything for us. We thought the phase 1 deal was going to be, the greatest thing ever, and that's done nothing so far at all. And so there's just too many. That is one interesting concept or thought that one of our board members had that kind of goes to your question that makes it more difficult. It seems like we're getting more and more of these what people call Black Swan. There's just more and more, whether it's war, the Iranians hijacking oil tankers, seems like every 10 minutes they're grabbing one of those. And there's just so many different things at the moment, and they seem to be popping up more frequently. And I don't want to sound like a global warming guy, but how the storms seem to be getting worse all the time. But there's just more and more what we would used to call Black Swan events that are getting, unfortunately, to be more the norm. And there was a guy actually wrote a book about that exact topic one time. I don't know the book, maybe Joe's read it, but it's called The Black Swan, or something like that. And it was just an observation by one of our board members that the things have just become more and more less predictable. I got to be honest with you, managing this margin from 2002 through about 2014 was like stealing candy from a baby if you were disciplined about it. It really was. It was simple to make money raising pigs outside of 09. But we were already short hogs in 09, and we were already long corn, but that was only because we had followed our plan. So when I say it was easy, I literally mean that. I don't even mean that arrogantly. I'm not an arrogant person. I'm just telling you it was very simple because we had the plan, and we actually followed it. And things weren't all that stressful. Now, let's just say your target's $25 a pig, and to your point, there's been times where it's been more than $25 a pig, and we didn't execute our plan. Like I said to you half hour ago, we should have had all our hogs sold already for as far as someone would have let us sell them, but we didn't do it because we got, ASF is going to be great. We're going to make more money than you ever made in your entire life. In fact, I know people, nobody in this room that I know of, but one person told me that who's well respected in our advisory arena, I'll just call it. And but that was his exact words. Well, now I don't know how anybody feels about the other thing. The other thing that's changed, and I was going to mention this too, is that makes it tougher is the packer behavior. I mean, the packers have been able to control margins like you would. It's crazy how much money the packer is making that didn't happen back in. There was more hogs sold on the open market in 2002 by a lot. The industry was not nearly as integrated as it is now. We got too many damn hogs, and people are still putting hog farms up. I don't know why, honestly, I don't want to offend anybody in here. I don't know why you'd build another hog farm today, why you'd even think about it. So the market's got to reset itself here. And we, as a percent of slaughter capacity, and that would be, Joe would know that better than me, just that statistic. But there's just too many pigs for how many we can kill in a week. When they can get 500,000 pigs to kill every week without even trying, and you ask about a new contract at the moment, and they say, well, this is what we'll give you, but if you don't want that, then we don't have any other options pretty much, and you're not integrated, what are you going to do? So it makes that decision a hell of a lot harder. And the packer, they have made that same thing a lot tougher. So, but you're right, there are times where you just got to say enough's enough.
Okay, if there aren't any other questions, let's give Bob a round of applause, please.